Hello and welcome to your Monday Futures Market Outlook for June 10th, 2013. This is Patrick Serezna. As always, we start off with a chart of the US dollar index futures, and we have to really take a very neutral stance at this moment on the US dollar. We had a very pronounced trend over the last 4 months that had us respecting the bullish trend of the US dollar. At this juncture, with the material damage that was done and the significant bounce in the euro, we have to take a far more neutral stance, as there's no evidence at this moment that the US dollar is going to resume upwards. At this stage, we are short-term oversold. There will likely be a bounce, and that bounce may even go as high as the 83 level on the upside. But really at this stage, if the US dollar doesn't miraculously put together a very impressive push back onto the upside, it's far more likely that the US dollar will be very range bound and may even tread down towards the bottom end of the ranges, which is the 79.80 level, before recovering. While this doesn't make us bearish the US dollar, it certainly does take the most our immediate optimism on the upside off the table. Next here, we want to take a look at the euro, and the euro is rally in the last few weeks has really been what's driven that US dollar weakness. The current euro rally up toward the top in the range is now going to give us some critical information. We could see very short-term thrusts even as high as the 33.50 level, but so long as the euro stays below those zones, it remains vulnerable to throwbacks back to the downside. But if we see any sustained strength above this 133.50 area, if it progresses above that focal point, then the window may open for the euro to actually come back to even retest that 135 to 137 zone above. That would be an extended period of US dollar weakness back to the bottom of the ranges. While we don't immediately believe that that is the most probable scenario, we certainly at this moment have to pay attention to see whether the euro has the intention of completing that move. Next year, we want to take a look at that 30-year Treasury bond as well. We have a very dramatic reversal from the bullish trend we saw in March and April that had us optimistic that Treasury bonds could have a very good push higher. At the same, we've now seen that reversal, and subsequently the round of weakness we've seen in the month of May not only wiped out all the progress it made in March through April, but now is even threatening to make lower lows. This is going to be a very big tell. If we get a bounce here on the 30-year Treasury bond that sees progress back to 142, 143 on the upside, we can take a little bit of a breather or neutral stance on it. But if we see any acceleration below this 140 level where it's already trading, then we have to be open to the idea that Treasury bonds may weaken down to even the 135 level in the upcoming weeks. So let's watch to see whether or not the bulls can hold the support line. Next year, when we take a look at copper, copper has been rejecting right along the upper focal points where we've been looking for. This is a very interesting the move that copper has done to the downside, because as US dollar weakens, it traditionally has allowed commodities to do relatively well in that environment. We've now seen where the US dollar is weakening, but at the same time a lot of these basic materials are also weakening, and at some juncture something's going to give here, and one or the other is going to become a more pronounced trend. At this stage, if the US dollar breakdown is still something that continues to develop in the upcoming weeks, we don't strongly feel that the downside of copper is going to have a very robust push. So I mean, we can maybe see a retest of the lows, or maybe even a support come in at 315 or 320, and then have room for even a bounce back up to 340, 345. It would only be under a scenario where we have a very robust bullish US dollar, where we could really see copper take a whole new level to the downside. Next year, I want to take a look at crude oil, and crude is probably one of the few commodities that has really strengthened a little bit on that weakness of the U.S. dollar. So long as the U.S. dollar stays down here, there is room for crude oil to strengthen all the way back to 98 or even 100 on the upside, and maybe even 102 if it really gains some momentum. The one thing we've seen with crude oil is that it really has been in a one-year range between that 85 level up to the 100 level, and that's more or less contained almost all the price action over the last year. So even if we do have a bullish follow through of $3-4, the question really becomes, will crude oil be able to break out of the range to the upside, or will, like treasury bonds, if come up to those highs and then reject off there, trading back down to the lows? We'll find out, but certainly the very short term leaves some room for the upside. Next year I want to take a look at gold, and gold remains quite distinctly weak. We have a little flagging formation that is already breaking down, and we circle those two areas where we felt there could be a potential double bottom forming, but really at this stage there is nothing bullish about the way gold is behaving. We put a blue box down below suggesting that if the gold cannot hold the support line, a technical measured move down to 1300 or even as low as 1200, if it's another crash-like move, is possible. We believe that in general in the gold market the pessimism is quite an extreme, and so at some stage anticipating a bottom in gold it becomes something that you could look for. But right now there's no technical evidence to suggest that we're ready to call that. So let's watch to see how gold behaves here, and particularly how it behaves as it approaches those previous lows. So when we take a look at the S&P 500, we had a correction that came right down to the 1595 focal point and found support and bounced on that jobs number. It's going to be a very interesting few moments in the market as we approach up to these midpoints around 1645, 1655. As the market approaches up there, we're going to find out whether or not the bulls are really going to follow through on the buy on dip. If the traders do truly buy on dip and do another measured move higher, we could see 1700 or even as high as 1750 on a follow through. But at the same time, this is a very dangerous moment, because if the bulls are supposed to be coming back and no one shows up, and all the traders realize that the bulls don't have the strength to follow through on the upside, it may become a catalyst for new short sellers to very aggressively come back in the market, and as well as profit takers to become far more proactive, which could lead to a much deeper pullback. Neither one of them is our prediction. In fact, we just believe that this week will give some very valuable information as to which one of the two scenarios becomes more probable. So observe this week whether or not the bulls can truly follow through on that short-term bottom. The more we see the bulls failing to follow through, the more concerned traders can become that a topping formation is coming in place. Just to make some key intermarket observations, we've changed our status on the US dollar based upon the most recent price action. The fact that the US dollar sell-off was so deep is starting to give some sort of signs that it's no longer an uptrend, but rather far more range-bound. This doesn't make us necessarily bearish the US dollar, but at this moment we want to first see what the euro does at these levels, as well as whether or not there's any follow-through on a Japanese yen short squeeze on the upside. We're going to watch to see how this plays out, but at this stage we're going to take a very neutral stance, as the most immediate uptrend that we were trying to participate in has clearly stalled out, and we don't want to remain overly bullish there. Our outlook on commodities remains very average. Even though, let's say, we're bullish on crude oil up toward 100, it doesn't justify us changing the rating on the whole basket of commodities. At some stage we'll see where these trends end, but right now we'll see how the price action develops over the next week or two. For bonds as well, we're right now at the bottom of the range. It's quite overdue for some sort of a bounce, and so we don't want to imply this this is a moment to take action. At some stage there will be a full Fibonacci style retracement back on the upside, but at this stage the uptrend that the bonds have had, and the move that we saw through March and April that had us optimistic on the upside has been violated, and therefore we need to see a brand new bullish setup develop in order for us to change our short-term status. And as regards for stocks, we wanted to take it off the most critical level of very poor to just poor, because we've seen a short-term bottom, and it's clear that stocks are going to go for some sort of upside retest, and we wanted to leave room for us to be able to downgrade U.S. stocks to a very poor risk-reward rating if there was another substantial leg higher. There is room in the current uptrend for the U.S. stocks to follow through like we talked about, and so we're going to watch to see how the price action continues to develop. That was your Monday Futures Market Outlook. Thank you for joining me.